Is the Fed fighting last year's battle? Retail inventories are piling up. Many commodity prices are declining. There are signs the economy is slowing. These are all indications of potential future deflation. Yet, central banks are tightening aggressively. On July 13, the Bank of Canada increased rates by 100 basis points. Markets are now assigning a 31% probability the Fed hikes by 100 basis points on July 27, up from just 7.6% probability recently. They are doing this to fight inflation. Released recently, prices in the US rose 9.1% over the past year, largely driven by energy, which rose 41.6%. Excluding food and energy, prices rose by 5.9%. Increasing rates in an inflationary environment sounds right, but the truth is the Fed is driving while looking in the rearview mirror. Prices today are 9.1% higher than they were 12 months ago. In other words, the inflation reported today happened in the past. I'm not saying central banks shouldn't be tightening. Indeed, they should have started tightening long ago. I am saying that by playing last month's, last quarter's, or last year's game, central banks repeatedly set themselves up to make huge policy errors. In all likelihood, by pushing up rates into a bear market and a slowing economy, central banks will go too far and will experience a hard landing. But what else can they do? They are making up for lost time and must deal with the realities we all see, rather than the possibilities some anticipate. When looking towards the future, central banks are notorious for getting it wrong. While they employ some of the smartest economists in the world, central banks have a poor track record for forecasting the very premise of their existence: inflation and economic conditions. Just look at the Bank of Canada Governor's statement made on July 16, 2020. In it, the Bank of Canada Governor promised low rates for a long time, explicitly encouraging big-ticket borrowing. In this statement, the Bank of Canada Governor said, "If you've got a mortgage, or you're considering to make a major purchase, you can be confident that interest rates will be low for a long time." I have the advantage of being an armchair quarterback. July 2020 honestly felt like the economy, including the housing market, was going to implode, so I get why central bankers encouraged people to borrow and spend and thought inflation would remain tame for a long time. You can also see how their views slowly evolve over time. Powell went from transitory to not transitory, strong economy to soft landing to we're crossing our fingers we don't plunge the economy into the depths of hell. These statements are simply a reflection of the mainstream consensus thinking at a point in time, so don't take it as anything more. They certainly have little forecasting value. By the time Powell states we're in a recession, everyone will already know we're in a recession. I don't blame them. Forecasting is very difficult because of the infinite number of variables involved, including irrational human behavior. Moreover, central banks have a lot of influence over markets and therefore can't be seen as shaping market direction. For this reason, central bankers sweat over every adjective and adverb in their statements to avoid swaying the market one way or another, allowing the market to incrementally absorb gradual shifts in monetary policy over time. At best, Fed policy and statements are a reflection of the immediate situation, a coincident indicator reacting to the data of the day. The data for today is 9.1%, leaving us with a central bank struggling to catch up to fight last year's battle.